Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. It seems like there's always something interesting when we're talking together.
Mike, of course, now it looks like the major markets are reacting to the coronavirus. Are you surprised it took this long for this to happen?
Sorta. On one hand, I am, because it's ignored it up until now. So it made it easy for me to think that, well, they could just keep on ignoring it. But then, on the other hand, the markets themselves had gotten themselves into a situation where, frankly, they could pull back at any moment with any news or no news or any excuse. And the reason I say that is that the stock averages went up at at almost 45-degree angle. At the beginning of November. They only had a pullback last month for a few days. The S&P 500 hit its 50-day moving average. Then we made new highs, and it just wasn't reasonable to expect the stock market averages to continue to go up at a 45-degree angle for the rest of this year. If they did, they would double, even from where they are now. So this was going to have an end. That rate of climb was going to end some way or another. I thought it could end, frankly, with just a slight pause and lost momentum and just go sideways for a couple months. But instead, we're dumping. The Dow fell 1,000 points yesterday, and today, as we're speaking at the moment, it's down about 400 points. And I would not think too much about the news in terms to the stock market and what to do or whatever, but instead look for some past comparisons to what happens when the stock market does have a violent drop just after making a recent 52-week high. And we saw that happen 2 years ago in 2018. The stock market had a sudden drop just over the space of a couple of days. The Dow fell 10%. At that time, they were blaming it on a malfunction in VIX ETFs, which is sort of silly to think that's the sole cause of the market pullback. And really, generally, I don't know if we can say there is a sole cause when these things happen. So yes, then the financial media talked about the triple ETF that shorts the market malfunctioning. Today, we're talking about the coronavirus. But I think it's the market structure that's always the most important thing. And everyone has been bullish coming into this year. And really, even if you weren't bullish, it's very difficult to imagine the stock market having a big drop because it's been so long since one has happened. And then if you were to even suggest such a thing, no one would believe you and you'd be mocked or attacked anyway. So that's kind of the psychological environment that creates sudden drops and pullbacks of the type we're experiencing. And another comparison I would make is way back in 2007. In February, the stock market averages fell about 10%, much like they are right now. And that drop was associated with the yen carry trade, which, no one talks about anymore, and they forgot about it a week later. Obviously, this news of the coronavirus is more meaningful than that was. I mean, it's going to slow down the global economy. It's also causing people to get sick and some people to even die from the sickness, much as people die from pneumonia if they, have the terrible flu and don't get over it. So what I would say is these type of drops tend to end in panic, in a washout. That's what happened in 2018. That's what happened really towards the end of 2018 also, not just February 2018, but the end of that year, in that fourth quarter. It's what happened in 2007. And we had several flash crashes too in the last, decade. And what you want to look for is the VIX spiking up, because it measures fear and panic in the market. The VIX is the Volatility Index that tells us the premium that options traders are paying when they buy options. It spikes up and goes up when they scramble almost to buy puts at any price because they're that scared. There's people that, instead of selling stocks, will hedge, and that causes this indicator to shoot up. Now, yesterday it went up over 40%, one of the biggest one-day gains I've ever seen in it. Today it's up so far 5%, and it's at around 26. And historically, when it gets to 30 and then comes back down, that tends to coincide with a meaningful bottom in the market that lasts for months. So I think that's what we're really heading for. I can't say the price bottom is going to come in today or in 10 minutes. I have no idea. No way to predict that. But what I can say is, if the VIX spikes again and above 30 or gets close to it and comes back down, by spiking I mean a move of more than 20% a day, and then finishes in the red today or tomorrow or one day this week, I would think that's the sign of a major bottom that's going to last for at least several months. And after the bottom does come, whether you think, the listener, that this is the start of a top in the market that's going to result in a new bear market before the end of this year, or is just a shakeout. Either way, after it ends, expect the market to go sideways for the next couple months before the next meaningful move is made. In fact, that's what happened in 2018 and last year too, for that matter. We went sideways, then soared in the last few months. So that's what to look for. Look for this selling to come to an end. It doesn't even matter if the coronavirus's cases increase or decrease. Once the washout is there, I think the fear will subside, and I don't expect the market will go lower. Personally, I'm not really trying to trade the S&P 500 or jump in or out or anything. I think one of the takeaways we can make from this is that gold, silver, and the mining stocks are continuing to act stronger than the stock market averages are. Last year, the GDX ETF went up 38%, when the S&P 500 went up 29%. The Federal Reserve lowered interest rates 3 times last year. That's a main reason why that outperformance continued. And this year, it's outperforming again. This action this week, the gold went through 1,600. It's currently around 1,650. It appears 1,650 is going to be the new 1,550, a new area to build support around for another move up. People should focus on that, I think, is to put in their portfolios as a hedge, because one thing that's now happening this week, because of the stock market action, because of the implications of the news of the global economy, the Fed fund futures, when a week ago they were only pricing in a less than 50% chance of a rate cut by July, today they're pricing in a 78% chance of one by June. So and at the beginning of the year, they were saying a rate cut by December. So all the news is pushing the next rate cut closer to us in regards to time, and that's going to be another rate cut cycle, and that's why gold, is going up, why it's going to continue to go up, why it's going to continue to outperform the market this year, why big cap mining stocks, I think, are the best place to put money, to make money. And you don't have to worry about them crashing or falling 10% in a day, or something like that. Gold's not going to fall 1,000 points in a day like the Dow has done, or 100 points in a day to make for, that kind of a percent type drop. That would be 5% approximately, a little less, but regardless. So gold, in an ironic way, is going to be less volatile than the stock market and easier to make money in. I think that's the key lesson to take away from the action so far in these markets this year.
We'll have more with Mike Swanson right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Mike Swanson. Mike, how do you expect the U.S. dollar to hold up during this?
Well, the U.S. dollar has had an interesting move over the past year. It's actually gone up, and gold has gone up along with it. However, I think it hasn't gone up in a huge way when I say that. And this year it's gone up a little bit, but I don't. A lot of people are very bullish on the U.S. dollar, frankly, and most of these people I see that are somehow thinking that we're heading for a repeat of 2008, because that year the U.S. dollar went straight up while everything else just about went down. And I think they're mistaken. I don't think we're heading for a 2008 financial crisis where the banks are in trouble or anything like that. Instead, I think we just have seen the dollar kind of make another breakout. It's been rallying now for a year and a half. But I don't really think it has huge upside, because one of the things we can look for now in the coming year is if the Federal Reserve lowers rates, and there will be another rate cut cycle, they're very limited on the number of rate cuts they can make. And last week, one of the Fed governors, her name is Lionel Bernard, she gave a critical speech on Friday when they lower rates next, in the next cycle of rate cuts, that they're going to have to get to a point where they say, okay, this is now a low level for Treasury bonds, and we're going to keep it there. And in order to do that, they're going to have to engage in massive quantitative easing operations. They're going to be buying bonds en masse. And the Federal Reserve chairman has also made statements last year in October, November, to the effect that they want inflation to increase in the coming years too, and it's not as high as they want it. These are all very dovish statements, but they're statements that imply that, there's going to be a tool in the future of not just lowering rates, but engaging in a massive QE operation. And all this has, again, bullish implications for gold, but bearish implications for the U.S. dollar when they materialize. They're not materializing yet, but I think we will see these sort of things become reality. Maybe not this year, but next year, or at some point when the next recession comes, this will be defining it. It won't be banks going under. It won't be real estate crashing. It will be inflation due to these monetary operations and a need to monetize the debt because the trade deficit will explode. It's already over $1 trillion. That's going to define the next cycle. We're not heading for a real estate crash. So that's why I think there's people who compare the moment now to 2008, or think that's Pete. I think they're wrong, and I don't think the U.S. dollar is something worth piling a lot of money into, expecting huge upside. I mean, yeah, the trend isn't down at the moment, but, you know, I don't see huge upside either. And if there was huge upside, gold wouldn't be acting the way it is. Gold is telling us to ignore the action in the U.S. dollar.
We'll have more with Mike Swanson right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, one of my guests was telling me last week that the Fed is worried that millennials are starting to save a lot of money despite low interest rates. Should that be a concern that they seem to be becoming financially responsible?
Well, that's right. And the Wall Street Journal, towards the end of last year, had several articles saying that, actually. And Jerome Powell made statements to that effect, too. And they were making the argument that they were scared that millennials in the United States are going to be like millennials in Japan. And what they meant by that is Japan has had deflation or a lack of inflation, in their view, for almost 20 years now. So the Japanese people, they kind of just wait for items to come on sale before they go buy them because they don't fear that prices are going to go up. So the argument is they think, the Fed people, that these millennials in the United States could start to do the same, that they won't spend money, they're just going to wait for bargains, and this will create deflationary pressures. And to prevent all this from happening, they want to make inflation above 2% and stay above 2% over enough time to program the millennials to believe inflation is real so that they'll spend their money. Now, it all sounds like, you know, a cockamamie theory, because on one hand, so what if people save? You know, and why is it necessary to have inflation? Why can't the dollar be a store of value? What's wrong with savings? So, you know, I'm not a big believer in those arguments myself. However, another way to look at them is that these arguments are actually propaganda, to cover up the fact that they know that one day the U.S. government deficit is going to require more QE operations to fund, and instead of admitting it when that time comes, they'll just create and present this theory and others like it to the public that, hey, we're doing QE for these other reasons, not because there's a lack of demand for U.S. debt, just as we have seen that in the banking system, they've had to step in and do repo operations due to a lack of demand. So I think that's why they know if interest rates get so low, and that there's just going to be a lack of demand for these debt instruments at the rates they're going to be at, that they're going to have to step in. I mean, look, right now as we're speaking, the 10-year Treasury bond is yielding 1.38%. That's just no amount of interest that I would want to lock up for 10 years. You just don't make anything. And I think more and more people are going to say that to themselves and buy gold, and some people buy stocks. The idea that why buy government debt and get nothing when I can buy some stock and get a dividend twice as big. And this is just going to make an eventual problem where there's not going to be enough real people out there wanting to buy debt that's probably unsustainable at such low rates of interest. So I think that's the real danger that the Fed is creating. It's a catch-22, because whenever the stock market drops, like it's done, the Fed starts, the odds of Fed rate cuts increase. The time where new QE is coming, grows shorter, and then they can make the stock market go up. But all these operations increase the imbalances and then make them more necessary. So it's all a wild, I think it's unsustainable, but, there's nothing going on in the debt market that wakes people up. All people want is Fed action to make the stock market go back up after it's fallen a little bit over 5% from its high. Any drop terrifies people nowadays, and terrifies the Fed too, and makes a new QE or cut almost inevitable. That's one of the implications of the drop of the past 4 or 5 days. But this, system of action, reaction, that's what we're in now. It's what's defined, everything in our memories, but it's not going to last, forever. And I think it's going to start to come to an end probably when the last rate cut is delivered by the Fed and they engage in some new QE. I think after that is when the dollar is going to fall, gold will go up even more, and inflation will start to hit people. But the Fed, in those statements you cited, seems to think they can control it, and just make it go up enough to force millennials into spending and other people to spend. But I heard such talk when it came to internet stocks in 1999 that Alan Greenspan could just master everything. He was a maestro, is what they called him. And I heard Ben Bernanke make claims that real estate was heading for a soft landing in 2006. So, nothing's falling apart at the moment. I think the market will wash out and this current drop will come to an end. But it's what comes over the horizon by the end of the year, next year, we got to prepare for. And the good news is gold, silver, mining stocks, regardless, seems to be the easiest way to now make money in these markets. And they'll also be the things that benefit the most if things like I'm suggesting become unglued in the future.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. You can find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.